Welcome to the Millionaire Next Door podcast with Robert Curtiss, CFP, accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work-optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
Well, hello, everyone, and welcome back to the Millionaire Next Door podcast. Today, we have an educational discussion. We wanted to go over what are called 1031 exchanges. What are these? If you own any real estate, investment type real estate, you may have heard of this. You may be familiar with it, or it may be totally new to you. We find it's of significant value to a lot of folks that have appreciated or highly appreciated investment real estate from a tax deferral standpoint. We've developed processes for this, and I wanted to bring on a guest. He's a member of my team and our research team. They do a lot of work in the space, finding the best solutions in the country. He's Joe Carey, Chartered Financial Analyst, CFA. He's an alternative investment specialist, and he's joining us today, and we're going to dive into that topic and hopefully educate folks. And Joe, welcome. Thanks so much for being here. Really appreciate it.
Thanks for having me, Rob. Yeah, that's a great background. I'm the alternative investment specialist at SEIA, which just means I focus on our due diligence process, underwriting, and monitoring private assets across the investment landscape.
That's great. But before we go into 1031s, would you mind I just came from what's called the CASE Alternative Investment Conference. We spent 3 days in Beverly Hills. It's really an interesting world. I mean, we heard from this Mike Pompeo. He's a former Secretary of State, and he was the director of the CIA. Let us know that we were in a pretty safe, secure spot. I didn't even think I was at risk, but that was good to know. But you know, we heard from a guy who's largely owns a portion of the Dodgers, the Lakers, the Premier Soccer League. You know, we're dealing with alternative investments. It's just such a different world for this high net worth endowment. We do a lot of work in that space. You're charged with really delving in and coming up with a great platform. Don't know if you want to make a few comments on that, and then we'll go right into 1031s, but a good opportunity.
Yeah, happy to. You know, alternatives broadly often come with a connotation of lack of transparency, expensive, or hard to access. And while some of those are true, the easier way to think about private assets is to simplify the investment landscape between debt and equity. If you boil down in the public markets, public equity is stocks, and then private or public fixed income is your traditional bonds, high yield, etc. The private assets fall under those two verticals as well. So if you want to be invested in equity, there's private equity. So these are businesses that aren't trading on exchanges, but are still well-capitalized, well-running, sound businesses that need financial capital in order to grow and succeed. And same goes for the debt side. It's very similar in terms of credit exposure, meaning that it's a premium for the risk taken for investing in risky assets, which is all assets are considered risky outside of generally government T-bills. But really, simply put, there's a lot of commonalities between public and private markets. A lot of the differentiation just comes into that access and some of the underlying characteristics.
Okay, perfect. And maybe we'll have you back to go into that, because that's a really exciting and emerging world. It's been out there, but especially where we're at, you know, with the economy, and it's a pretty safer bridge. And a lot of folks we work with haven't really been invited until now to participate in that type of thing. It's always been some exclusive thing that they didn't qualify or know about. but we've kind of developed some processes. Pivoting right into what the topic of the day was, do you want to talk to us about, give us an introduction to the 1031 exchange program? What is a 1031? Who's it work for? Just tell us what's going on there.
Yeah, no problem at all. So 1031s are actually a long dated tax code that's actually dating back to the mid 1900s. So it's been around for a very long time. But ultimately, what the IRS was intending to do was allow for investors in real estate assets the ability to sell and relinquish property, but reinvest those proceeds over time, or follow on invest those proceeds and do so without having a tax burden on that initial sale. So ultimately, the mechanics of a 1031 are rather simple. You're buying and selling real estate, and what the tax code does specifically is allows for a deferral in the realization of capital gains taxes if an asset were to appreciate, but also, as is very traditional in real estate markets, you can write down assets over time through a depreciation schedule. What this does is bring your basis down, or your taxable cost, right? Which again inherits a larger gain on sale. So oftentimes, without the 1031, if an investor were to sell a property, there's oftentimes large embedded gains that would require a tax consequence upon sale. So the 1031 program is designed to remain invested in real estate long term without paying capital gains as you rotate between assets over time.
Yeah, that's big. We've had a lot of discussions with clients, you and I. So for example, there's a gentleman in Texas. He's taken over, his client of ours, he's taken over as trustee for his mother's estate. There's an apartment building, or sort of a duplex. I think they paid about 200 grand. It's worth 600 grand. They're really tired of the maintenance. He's got a lot of other things going on. There's a $400,000 unrealized gain that, if it was sold, would be subject to capital gains plus a lot of costs, probably, of some type of transaction. So we walked him through how that would work. There's other examples. I'm bringing it up a lot. We talked with another woman. In Texas, they own apartment buildings in Milwaukee. So similar kind of situation. I'll let you continue on, but those are just to give people an idea of, what's out there and the avoidance of these large gains.
Yeah, Robert, you made a good point too on who this might be applicable to. Again, it's generally clients invested in investment properties. And what really constitutes a 1031 exchange, or allows for eligibility for a 1031 exchange, is what's called a like-kind exchange. That definition has expanded over time, as recently as 2004, to really allow investors in any kind of direct real estate investment to exchange into a direct real estate investment. And that's an important clarification. So for those that are sitting on the other side of the table thinking about how might this be beneficial to me, and they have a two-family rental property, or they have a land that they've been leasing, right, that's been generating income. These are different types of properties, but they fall under the category of for investment purposes. So under the current 1031 exchange rules, both of these property types would be equally eligible for 1031 exchange processes, in that they were investment oriented at acquisition, and then you're remaining to be investment oriented go forward. What really differentiates the 1031 space, and there's many ways to do this. For someone that's maybe new in their real estate investing journey, and is trying to take an active role in real estate management, they could use 1031 exchanges all on their own, meaning they work with the required professionals to go through the process, but ultimately they pick their next property, they manage their next property, and benefit from the tax benefits of rolling all invested capital and proceeds into the new deal. But there's also what's called 1031 exchange DSTs. And what DSTs are a legal structure that allows for an external manager to acquire property on your behalf, manage the property on your behalf, but you get to roll your capital on a tax advantage basis into this program to basically relinquish the active duty. So there's really two avenues you can go. You can maintain active management, or defer it to professional management. At SEIA, we tend to recommend a deferral mechanism, but that's it's subject to suitability and kind of time horizon and goals. There's many different facets that are considered, and Rob, you know that very well. So just wanted to point out that there's a couple different unique ways to use these to your advantage.
Yeah, that's great. And in the cases I cited before, they didn't want to be actively managing. They didn't want calls from landlords. They didn't want to collect rent. They didn't want to pay property taxes, insurance. A toilet goes out. There's a plumbing issue, a landscaping issue. They just wanted to relinquish that and collect an income and have it be passive. So that's a good fit. Yeah, continue on. Yeah.
On the
ahead.
back of that too, the relinquish of active management ultimately serves the same goal of either outcome, in that you're maintaining a long-term exposure to private real estate that is income producing. But when you relinquish the active management, you kind of relinquish the headaches and let your capital do the work for you. So really, it's a great solution for those that are looking to again, not be as involved in the day-to-day and the leasing part, the rent collection, as well as the operating and maintenance of the property. But again, the underlying exposure that you're getting through a DST 1031 program is still largely the same, in that it's direct owned real estate that's income producing and of high quality. Oftentimes, DSTs are formed to aggregate capital from a bunch of investors looking to invest in 1031s. What that really means is that by pooling capital together, the managers on behalf of the clients can acquire more expensive properties. And in the real estate world, more expensive properties tend to be in more desirable areas with supporting demographics for their particular focus, whether it be life sciences or multifamily. But by purchasing these better assets, these or more expensive assets that tend to be of higher quality, you're getting exposure that you yourself directly wouldn't necessarily be able to buy a property in that same category. So it's also a unique way to take what success you've had in real estate to date as an active manager and roll that into a continued part of your overall portfolio, but do so with professional management, do so with higher quality properties that would be much less attainable directly. And then on a separate layer is that then the management is done for you, and these managers have long tenure often in managing these type of properties and owning these specific type of properties.
Yeah, so often I see where these people want to exchange that property, but they're sort of desperately looking because there's a very limited time window to identify a new property, and they're considering some property in a strip mall in Kansas City or something that they maybe seen some photos of, but they don't really understand the area. Maybe there's a real estate broker trying to get that through, versus the types of properties that are much more institutional, right? And selected through top level management, maybe a life science, data warehouse all over the country, and diversified out, but in regions that are growing. And then they have this limited time window. This sort of satisfies that because they can get into it. Can you talk about that? And then also the income that can come off of these things, and how soon does that actually start? Once
Yeah.
it closes, I guess. Yeah.
All right. Yeah. So, first thing, what you brought up, Robert's a really good point around the timing of these 1031 processes. And it is rather tight. For investors looking to do a 1031 program, there's only 45 days to identify a replacement property for this transaction to unfold. And for an average investor, that's very challenging. So that's from date of close, you have to identify the next property you're going to invest in within 45 days. So you can either start that beforehand and hope everything goes as planned and you're able to get that done within 45 days. But if you're unable to do so, it becomes extremely, extremely stressful. You don't actually have to close on that property until 135 days following the identification window, but it is definitely a difficult place to be in for your average investor. The way DSTs work, on the other hand, is they acquire properties prior to listing the 1031 exchange for external capital. And what that does is really it removes that identification problem from investors as they look to rotate this capital into a different asset. And another thing you asked about was the income that you can expect on these types of properties. And that would be, it's very subject to the underlying asset during the DST phase, because you are buying cash flow, you have a cash flowing asset, and it's that asset in particular, right? So it can change depending on if it's a life science building, if it's a distribution center, or if it's multifamily. But generally speaking, the way DSTs are set up is what they call a master lease agreement. And what that is designed to do is create stability and cash flow of the underlying asset, in which the manager is taking care of, again, all the leasing, rent collection, all that. And then by having that aspect of the business covered, they're using the master lease agreement as a grantor to the distributions from the property. Right now, we're seeing about a cash flow rate about 5 to 6% on average. And I think that's rather consistent in the institutional property markets. Yeah, happy to dive
Yeah.
in more there or
Yeah.
whatever you think.
Yeah. A couple other quick, is that regular like 1099 income, or how is that? Or do you know?
Fairly certain this is a K1 producing income asset
Okay.
class, and that's
Okay.
given the private nature
Yep.
of the assets. The valuation process is not as tightly regulated as you would see in the public markets.
Yep.
That does not mean that it's inferior or anything to that manner. It's just a
Yep.
different process for these types of assets. And what that takes is it takes more time to review. The real estate market in general, and as many real estate investors know, is a highly fragmented market, which creates some nuances in valuation. Sometimes there's not always a very good comparable property, or some of these other things. Maybe the transaction activity has been muted. So it's a more complicated valuation process that translates to a longer time until the valuations are inked for good, which ultimately translates to a longer tax filing preparation process.
Okay. That's fine. I mean, there's a lot of tax savings that goes on here, so it's probably worth getting an extra return, and your tax preparer can deal with that. I get a K1, so it's couple other thoughts. I want to talk, when we had our discussion with the folks from Texas with the property in Milwaukee, remind me if I heard this correctly, you were comparing to some of the other DST type stuff out there, but the processes we're utilizing for our clients that we're making available, which are very, very highly vetted, professional, institutional type management processes. Did I hear you right to say that ultimately the costs, ongoing of those kind of things that we're using might be about 25% or a quarter of what's typically out there if people don't go through processes like this? I don't want to
Yeah, I
set
don't
up for
think
a
I put
poor,
a
yeah. Yeah,
yeah.
how does it compare? Let me ask you that way. Yeah.
I think that brings on a good point about the variance in the quality of DSTs that are out there. Our business focuses on institutional managers that have breadth and scale as well as exceptional track records in their core market focus. A lot of DSTs out there are smaller real estate managers that tend to be more regional, which isn't necessarily a bad thing, but tend to be more focused on a particular area. So they lack flexibility in that regard, and their smaller nature tends to lead to higher expenses for them to transact. On average, I would say the more regional or smaller DST programs out there are more concentrated in their area of focus. It might only be one property, as well as the fees around them tend to be higher. I think on a comparison basis, we've seen some of the smaller DSTs with, call it a rough upfront cost of almost 10%. Some of the more institutionalized managers are closer to 1 to 2%, maybe 3 on the high end, which is a large delta. So while you are getting a benefit in tax savings, right? If let's say a tax rate on that gain is 40%, and by deferring it, you're only paying 10%, and with another DST program, it still is a handsome trade-off. But long-term implications is there is principal that is lost to a substantial amount of fees. So we want to orient ourselves with managers that are cost effective in executing the program, and then again have the capabilities, the scale, and the resources to really execute on their desired plan.
Okay. Yeah, that's what I was driving at. I think this is much more efficient and lower costs and probably much higher quality. When you were describing sort of these big expensive properties, and you sort of brought me back to the game Monopoly. I was thinking like those properties in the deep blue right next to when you go around right, the boardwalk. Those are really expensive, and the ones at the beginning of the board are really Vermont, and they're not. And I just remember from days of playing, when you start if you could control those and that's how you probably win the game, not by the low end stuff. So it kind of made me think a little bit of an analogy around that. But hey, one other, totally pivoting here. This is tax deferral, right? Like, for example, someone paid $200,000 for a property. It's worth 600 now. There's 400 in gain. That all gets deferred. But let's say one continues to defer that out, and then ultimately in someone's estate, someone passes away. Is there then a step up in basis, in a trust where really there's no taxes due and it jumps to current market value somewhere down the line? Can you ultimately defer it out until there's a step up in basis and assets are passed free from capital gains?
Yeah, so thus far, we've really just focused on the differences, the information or the background about 1031s, as well as how to get into them and the time around that. But what we haven't really focused on is the impact that has on the back end or towards the further along in the investment's life. And you bring up a really good point. This is a tax deferred strategy until there is either sale of the asset, or to your point, if there were a death and it were in a trust, there is a step up of basis, which would immediately remove all embedded capital gains previously that had been deferred, which is an extremely beneficial wealth planning tool. And ultimately, one thing, again, with our focus being on the front end of 1031s, what really we think is unique in the space and is allowed under the 721 code is what is called, or was broadly referenced as, like an UPREIT transaction. And what that means is a lot of managers are using these 1031 programs to acquire assets that they ultimately want to have exposure to long term. What they're doing by singling the asset out and allowing for 1031s is, I think, kind of like like a friend lending out a hand, right? They don't have to do this, but you appreciate it. And they're doing so to help their clients and their investors defer that income. But ultimately, what they want to do for themselves is put that property into their broader diversified pool of properties that are housed in their real estate investment trust, which is a conglomerate of private assets that get serviced and provide income long term. Ultimately, what they want to do is the 720 exchange after 2 years of ownership, plus to acquire that asset. And what that does for investors in the DST is allows them to convert their ownership percentage into shares of the overarching REIT. And really, the only the complications of 721 are there, but to make it a little more simple, what they're doing is not a physical sale. So basically, they're acquiring the property without being a sale process, which allows for transfer of ownership again on a tax deferred basis. So now what you do is you have exposure to a broad pool of real estate assets and maintaining tax deferral, but also have exposure again to a larger pool of assets. That creates more resiliency in your real estate portfolio, but also many of these REITs have liquidation set up basically to offer it, either quarterly, semi-annually, annually. There's a range of different varieties out there, but that lets the investors to adjust their positions over time. You can realize small portions of capital gains to kind of manage tax burden, or again, you can defer until death and have that large step up in basis. But really, using a DST program that has a 721 optionality just creates more flexibility in the outcomes for investors. And we view that as a highly favorable manner to maintain long-term exposure to real estate, but allow for dynamic allocation depending on client needs.
Right. I like your term dynamic allocation because what I'm thinking, if you own some property somewhere, and the reason I mentioned the step up, because there might be people in their 70s or 80s, or 90s who own these things, and the reason they've appreciated so much is because they've owned it 45 years. It wasn't like a 5-year type thing. For example, the couple we spoke with, they live in Texas, that had the property apartments in Milwaukee. That's probably been nicely appreciated because they've owned it for many, many years. But who's to say going forward that's going to appreciate at the same rate or be as desirable as if someone has an institutional type manager and they can look at opportunities across the whole country. For example, maybe warehousing or data outside of Salt Lake City, or a property servicing oil and gas outside of Dallas somewhere, or a medical office building in Palo Alto, California, that kind of thing. So you've got that active management, I think, going forward. And another point, a lot of folks they've had this dramatic appreciation because they've owned the property so long. Maybe they've owned it 35, 45, 50 years, and they're in their 70s, 80s, or 90s. That step up is absolutely giant. And you're doing this in a very cost-effective way relative to, I don't want to criticize some of the other smaller ones that you brought up, but it's a little bit more of the Wild West out there. And this is really a very sophisticated way to go about it. So those are just a few thoughts that come to my mind, but I'll let you chime in there.
Yeah, no, I think reason costs can get lowered for some of these more institutional products is really the scale that they have. They're leveraging a deep bench of internal professionals that are on the ground in these different target markets. They have a deep bench of legal professionals and other asset managers that service the properties themselves. And by having scale, you're really able to invest across the country in these key areas without incurring added expenses, as if you or I were hop on a plane and go scour the market and let's call it Raleigh, North Carolina, right, and look for some medical buildings. Like we would have to get hotels, we would have to buy flights and take time out
Yeah.
away from work to do it. By having boots on the ground, you're able to do so without incurring all these additional costs and maintaining that flexibility to stay in high conviction and locations and assets. So yeah, we definitely view the institutional side of the 1031 exchange business as particularly interesting. The assets that they acquire for the most part are core stabilized assets. What that really means is again that these are the best quality, best location, and well leased. In that construct, you're not necessarily making a bet on appreciation anymore, or you're kind of removing the appreciation volatility you may experience in your own real estate book that you're actively managing. By taking out that volatility and appreciation and focusing more on core real estate that is more stabilized as well as more income producing, that's more, for lack of better words, stabilized, the trade-off is a much more robust allocation to private real estate in the long term. Again, these are assets that you can't necessarily get exposure to on your own, especially directly like you would through a 1031 exchange program. Oftentimes, these are assets that are housed in other public real estate investment trusts or private real estate investment trusts, which are often access constrained. So by using these programs, you're often able to get access to very, very high quality managers that are otherwise difficult to get overall exposure to.
Yeah, that's terrific. And a big point I want to emphasize is we can have discussions ahead of time with this. We were on the phone, with the folks from Texas, had the property in Milwaukee, another Texas client who's just taken over for his mother's estate. I had two conversations yesterday. Yesterday with a person who's retired, but her and her partner ran a business in Glendale, California. They own the building. It's worth a couple $1 million, highly appreciated. They're thinking of selling it next year. I said, why don't we have a discussion about a 1031 for the tax deferral that, just we'll walk you through on a very personalized basis. Another discussion with the gentleman yesterday, owns an investment property in San Luis Obispo, California. Same kind of thing. And this guy is a pretty good sized property owner. He says, oh, really? You can do that? I didn't know that. I said, let's have a discussion about that, John. So we can have these discussions ahead of the time. The folks who own the place in Milwaukee were actually closing like this week. I followed up. They actually had a deep conversation with their CPA and they're going to sell that and realize the capital gains. But that's in concert with their tax professional. They told me we own several other properties, so we'll 100% keep you in mind for all these and we'll have discussions. So we can think that through. We can bring in legal experts, folks like that, without sending you a bill. We can pre-plan it, let you know. Do you want to give maybe an example or two as we start to close out, and then also cover any other big sort of points that haven't been covered that you think should be mentioned, Joe?
Yeah, I think you brought up an excellent point. These are somewhat complex in nature. You are talking about ownership of your property, but also you're working the tax system and tax code. to have a favorable outcome to remain invested in real estate. But to do so, I want to drive home that point as well. You really do want to have these conversations early. As with anything, tax planning should be handled. These are events that often have a lot of thought that go into them for the implications on, the current investors' active ownership now. What's their responsibilities going to look like through managing the asset and through the sale process? What's their tax burden going to look like? And having those discussions early, again, bringing in experts in these areas really helps instill confidence that you're in the choice being made to roll capital using a 1031 or relinquishing active management with a 1031 DST. I think it's a great way to build relationships with clients from a financial advisor's perspective, but also for advisors to provide unique solutions that really showcase the breadth of service offerings and how they can really help you meet financial goals. From things we didn't cover perspective, to be eligible for a 1031, and this is the most asterisk statement I can make, you need to have what's called a qualified intermediary involved in the process of your sale. What a qualified intermediary is basically a specialized escrow agent that ensures the handling of funds is in line with tax code to be eligible for the 1031. They do all the work for you, and it is a requirement to participate in 1031. So if you're thinking about that, get in touch with us, and we can help talk through the nuances with that. But that's an extremely important point. If you were an investor that just sold a property, let's call it yesterday, received funds and did not engage with a qualified intermediary, you wouldn't be able to 1031. So that's, again, points to the planning process around 1031 exchanges, as well as knowing the nuances and the complexities to make it happen from start to finish. Outside of that, Rob, I think we've provided a great overview of 1031s from a high level. I would encourage, further discussion in the space. I think it's an exceptional tool for deferring capital gains taxes on actively owned real estate or inactively owned real estate. And I guess I can highlight that quickly. If you are in a 1031 now, and that 1031's looking to sell their asset, and meaning it did not go through a 721 exchange process, those dollars qualify for another 1031, again, because that definition is based off of like-kind investing. So really, it's a very flexible strategy. It's highly advantageous from a tax planning perspective. And ultimately, my view is, if you've been invested in real estate and you've seen the benefits of income and appreciation, odds are you continue to have a favorable outlook on having that as an allocation in your portfolio. These 1031s are just a way to do so at a tax advantage basis, but ultimately remaining invested in the asset class as desired.
Yeah, that's a great summary. And please let us know, anybody who's listening or clients, if you have any use cases. We'll hop on a call. We spent close to an hour with the folks in Texas, with the Milwaukee property. As I mentioned, they chose to spend a few $100,000 on taxes. I mean, after consultation, that's great. If we can help you avoid that or just walk you through the process. Joe mentioned there are a couple ways to trip this up, not using the qualified intermediary. Let's make sure it's not, if it's handled by people who know what they're doing, we'll do it the right way. If you don't know what you're doing, it's probably easy to mess up, and that can be very expensive. So we'd be thrilled to have sort of a sounding board, educational discussion about it. It's so interesting to hear you say this has been around since the middle of the 19th century. Client asked yesterday with an investment property, how long have these things been around? Is this something the IRS even likes, or is this on their radar? I said, no, these have been around. I didn't know since the the middle of the fairway. This is not a extreme tax avoidance strategy we're looking at. It's pretty darn vetted, correct?
Yeah, this is pretty much a core proponent of tax code for the last almost century. Very, very time-tested strategy. Regulation can always change. But in current form, it's something that we view as highly favorable and has
Right.
been highly used by those with wealth in real estate for a very, very long time.
Yep. And I'm just about to close, but I do want to say you're absolutely right. Things can change. Tax code, the step up is vetted right now. It doesn't mean it couldn't change sometime in the future. If someone's seen dramatic real estate appreciation, I would consider that fact that it's not, we have a pretty enormous deficit going on in our federal government. They may be looking to close that at some point. So just beware. So that is just so helpful. We'll get on a call together if anybody wants to explore this. Just another example of how we're trying to educate and assist clients. And thank you, Joe. We'd love to have you back, talk about some other alternative investment strategies and how that's helping folks. So really, really appreciate it. Thank you so much.
No problem at all, Rob. It's been great, and happy to provide insights on the space. It's a unique opportunity, in my opinion, to be invested in alternative assets as an individual, and they can have a meaningful impact on overall portfolio composition. With 1031s being a very unique solution within that purview. So again, really appreciate having me on as well, and for the time today. It's been phenomenal.
Yeah. 100%. Thank you so much. And also to anyone out there, we'd be happy to have your CPA or tax advisor on anything just to help make sure everyone's on the same page. So, hey, make it a great day. Thanks for being here. And we appreciate folks listening, and hopefully this has been helpful.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors.
Signature Estate and Investment Advisors, LLC, SEIA, is an SEC registered investment advisor. However, such registration does not imply a certain level of skill or training, and no inference to the contrary should be made. Securities offered through Signature Estate Securities, Inc., member FINRA SIPC. Investment advisory services offered through SEIA, LLC, 2121 Avenue of the Stars, Suite 1600, Los Angeles, California, 90067. Telephone number 310-712-2323.